Well, let's see if my next guest feels more optimistic. Lucy MacDonald manages about $9 billion as Chief Investment Officer for Global Equities at RCM. Lucy, great to see you. Thank you so much for coming in the studio. There's been so much volatility over the last couple of weeks. Are you expecting more of the same? So uncertainty and basically fears that a double-dip recession may be on the cards?
Well, we are still in uncertain times, and so I think it's a little bit early to be fully positive, but we are seeing more value emerging in the market. And fear and loathing has been rising, so sentiment is very depressed. Now, that's normally not a bad starting place for an investor, but there is still a lot of uncertainty about the level of growth. And although that is now priced to a certain extent into shares, we still really need to see how the economies develop over the second half of the year.
So will you change your portfolio, and your strategy depending on whether we hear Ben Bernanke talk about QE3 and whether he commits to it actually down, right up front?
No, I don't think we are looking particularly for help from the politicians on this score, either in Europe or in the US. Not that Bernanke is a politician, clearly, but we are looking particularly to see how earnings come through in the next session.
The next
because
round, yeah.
Certainly coming out of the last quarter, July appeared to see a sharp fall-off in activity for those companies which are more industrially active. And that, I think, is a concern. So we need to see how that's developing into the autumn, because this time of year clearly is generally quite quiet and you don't get a very strong picture.
So talk to me a little bit about the industry groups that you're focusing on, because if we look at a percentage of the things that you have in your funds, financials are quite prominent. 17% of financials make up the fund. Are you not worried that there's overexposure to one of the industry groups which is the most uncertain at the moment?
Well, we're underweight in the financial sector, and particularly in Europe and the US, and where we have our exposure in the financials is more in Asia, where you have less concerns about debt. And so that's an area where we have been cautious for a while, particularly in the developed markets. Where we are more positive is in healthcare, where we've been overweight now.
Because it's just more stable.
There's less economic sensitivity, and also there was quite a lot of value, and there still is actually in that area. More stable growth. The consumer staples area is interesting, but a little bit more expensive. And
this, Lucy, is across the board, or is it, for example, would you be looking at consumer staples in emerging markets, just because growth there seems to be so much stronger than certainly here in Europe and also in the US?
Yes, and we are very stock-specific in our investment, and so we are looking for companies which can access growth wherever it happens to be in the world, and that is one of the attractions of some of these consumer companies, that they have got quite a broad geographic spread, and that gives them some balance in this sort of market. The
UK, an odd one, because of course this is now considered a refuge, a haven in itself. Are you picking up more stocks in the UK because they're very dividend rich, and at the same time they seem to be weathering the storm much better than our counterparts in Europe? We do have a certain exposure in the UK because it is quite a global stock market, and therefore you do get a certain amount of diversification. As you say, there's yield and income, which is attractive in these sort of times. So yes, we do have a certain amount of exposure there, but not to the domestic, because we think the domestic economy here is still, although not the worst in Europe, is not in great shape. What about oil and commodity stocks? Because today we have a little bit of a debate going on in Bloomberg that it's uncertain whether the fact that we may be looking at double-dip recession will drag these stocks lower, or on the other side, because there's not a lot of stuff on the ground, they will actually rise in the next year or so.
Well, I think you can divide that sector into the quite stable, integrated, high dividend yield companies, which are not a bad place to be hiding in a volatile market. And then some of the higher beta, the exploration companies and the service companies, and those in a high volatile market can be a little bit exciting. However, they probably see better growth in the medium term. So I think those are some areas where they derated quite early on, and we've been starting to pick some of those up. However, I think if Libya does come back on stream, you will get oil prices coming down.
A little bit of a dip, yeah. Lucy, thank you. Lucy MacDonald there.